Good afternoon, everyone, and welcome back to TBD, your Colorado Springs real estate podcast. I'm Rob Thompson, associate broker here with the agency, and I'm joined once again by my colleagues.
Hi, I'm Laurie Ristig, also with the agency.
And my name is Mike with Total Lending Concepts.
Welcome back, everybody. Today's topic is all things mortgages.
All things mortgages.
But first, we have our market stats. Laurie, what you got?
All right, so comparing March to April, days on market, the median last month was 5 days, which was already ridiculously low, and now it's down to 4. Average sales price last month, $327,000. Now it's about $328,000. There was a couple dollars at the end, but it was about $1,000 difference. And median sales price went from $290,000 to $285,000. So that actually went down. So
That's interesting because that was the spike.
Mm-hmm.
I was watching for that spike, and I want to say for approximately 14 months we had a 285 plus or minus 5,000 was the median.
Mm-hmm.
We hit above that spike briefly about 3 months ago, and now we're coming back down as interest rates have risen. It's interesting to see a little
bit of pressure, maybe,
to downward pressure back on that, even as inventory has shrunk and the
Mm-hmm.
average purchase price goes up. I think we're down to 1,109. Or around 1,109 single-family homes in El Paso
Yep.
County.
Mm-hmm.
Yeah.
And at 300,000 and below, there's only 192 of them.
So still record low inventories.
Yep.
That's crazy. I saw also the median purchase price, if you remove all barriers, so just the median purchase price of single-family homes in PPAR is $429,000.
Yeah, the current active homes, yeah.
Right. If you, Mike had an interesting point, using that same, interesting enough, that same number, 429,000, if I'm not mistaken, is the conventional loan barrier. Above that, it's a jumbo.
Above that is a jumbo. I think that it's close. It's
Okay.
not the exact number, but it's relatively close.
So if we use that as a barrier, though, then and remove the outlier properties that are million plus,
right,
half million plus, the average purchase price falls to $323,000, which is still quite a
mm-hmm.
average for our market. So what do we think? Do we see inventory spiking anytime soon?
I mean, it's spring.
I think
Bound
it's
to go
getting
up a
absorbed.
little.
I
Yeah.
think it's just getting absorbed as fast as it hits the market.
Exactly.
Well,
With
so
4 days
3
on
days
market
before, yeah.
means that they get removed right off the market. So we may be seeing the same amount of homes. There's just that many people out looking to buy.
Sure. There's
So
a spike in number of homes available, but there's a spike in number of buyers, so then those available homes go bye-bye.
So then there is no inventory surge. Yeah, on the horizon, I agree. It's getting absorbed as fast as it's come on the market.
Yeah.
So it's almost a moot point. A tough time to be a buyer or a buyer's agent, solely, right? Yeah.
Awesome time to be a seller.
Yes, particularly for
But is
49
it?
or below.
If you plan on selling and leaving Colorado Springs,
Yeah,
Good point.
great.
it's great. If you're planning on selling and hoping to buy, then what do you do? What's your strategy?
Well, then you say, I'm not going to close for 2 months. I will sell my house to whoever wants to purchase it.
Buyer X.
Yep, but my closing date is a minimum of this date because I would like 60 days to shop and get under contract on something or something like that.
Or a rent back scenario,
Right.
or a termination if they
Yep.
can't find something.
I would suggest if you're
Specific time.
upgrading, it'd be easier than if you're trying to downgrade
Agreed.
For
Because
space or price.
Or a lateral move.
there are more
Yeah.
homes available at the higher price points. So if you're upgrading,
Yeah, if
Yeah.
you're upgrading,
Mhm.
if.
Sure.
And I know some people who are trying to move from one district to another. So that's.
I
yep.
think I'm just going to buy a bus and, and just travel around the
Are you going to
Springs in my
paint a
bus.
Partridge Family on the side?
Well, there you go. We're yeah. Oh, well, that topic leads into mortgages, Mike.
Mortgages, yes.
Yeah, Mike's got a couple pages of notes here. He wanted to share some information on. Let's start, Mike. What is a mortgage?
Mortgage is a note that you would take out against your house. We would lend you X amount of dollars so that you can move into your home. So you own it on title, but we own it on paper.
What happens if you don't pay your mortgage?
We take our asset back.
Foreclosure.
Plain simple.
Yeah. Okay.
Don't pay your
So-
bills, you lose what you don't pay for.
That's fair enough. A
Yeah.
mortgage is a loan secured by the home.
By the asset,
Right.
correct, the home.
What happens if I don't pay my taxes on my house?
It's potential that it could be taken, but the lender is going to step in and pay that, and then they're going to come after that money from you as well, and turns back to you. If you don't pay, then you lose the house.
Gotcha.
The lender's not going to lose the house to the county on taxes. That's just not going
They'll
to
step
happen.
in, pay the taxes
They'll
themselves.
step in and make sure that gets
But
paid.
then assess that as a
Correct. Correct.
a ding
And
against
then
it.
they'll reevaluate your payment. Your escrow account is what they'll do, and then your payment will escalate to reflect that.
Speaking of, my payment just went up $60. I got a notice of my my payment's going up $60 because insurance is rising
and so are taxes.
Taxes.
Yeah.
That's interesting.
So
because
you had
mine's
an escrow
going
shortfall.
down about $100 because I went online and looked at my insurance and saw I had a $5,000 deductible, and I've had 0 claims on my house. Could something happen? Sure. Would a $500 or I'm sorry, I had a $500 deductible and I raised it to a $5,000. Flip that, reverse it. So yeah, I was like, what would happen if I had a $5,000 deductible on this? Because I have $5,000 sitting in my savings account if for emergencies, you know. And so I did that. My homeowner's insurance went down like $600 or $700 a year based on just the deductible. I didn't change anything else.
Not questioning that decision, but that is can you that's 50 months? No, that's not 50 months. Yeah, how many months does it take to replenish that if you had to spend that emergency fund?
Oh, right, because it's about $100 a month. Yeah.
Yeah, so it'd be 4 years and 2 months to replenish that.
We've been in our home and have had 0 claims.
Yeah. Well,
And we have
knock on wood.
and we have, and knock on wood, and we have our roof is relatively new, and we have the hail-resistant shingles on it. So
Okay.
I'm like, what are the odds we're going to use this, really?
Fair enough. And if you have the money dedicated aside, then yeah.
Sure, and we've got the savings set aside, so if we did have an emergency, we could cover it. But
And it's not like
our
that
monthly,
money.
but that makes my monthly payment go down $100
It does,
a
and
month.
it's not like that monthly payment is going into. It's not like a savings account. You're not
Right.
that $100 a month that you pay is gone to
It's
the
gone.
ether.
So we decided instead of paying that extra $100, or instead of just not paying that $100, we're going to put $100 extra toward principal every month because we already
There you
pay
go.
over every month. If we have, I put money into savings, and then whatever I budget what we need for week to week, basically. So I'm like living paycheck to paycheck, quote unquote, but I'm not. Like, we have savings set aside and whatever. And so whatever I have at the end of that 2 weeks until my husband gets paid again, because he has a regular paycheck and mine is more, it's irregular.
Yes.
So if we've got a couple $100 left from that paycheck period, we stick it into the mortgage payment to pay it off faster.
That's smart.
So we were like, well, we can do another $100 extra every month paying off the mortgage. And if you're gonna do the math on, I don't want to do the math on that. It's too much. But if you want to do the math on that, the whole, how long will it take for you to replenish that? Well, how much extra interest would I be paying on that?
Well, you just knocked 7 years off your mortgage
Yeah,
approximately by doing what
exactly.
you're doing with
Yeah.
that little move. Yeah,
Pumping
nice.
that extra money into the mortgage. So
Nice.
the goal is to have it paid off by the time I'm 50.
By the
I
time
won't
you're
tell you
50.
how well. Sure, I will. I'm almost 40. So if it's paid off in 10 years, I'm going to be a happy camper.
Right on. Well, okay, Mike. What else you got about mortgages?
Well, I wanted to talk about some of the programs that are out there. A lot of people approach me in regards to zero down or assistance in purchasing, and that would be CHAFA here in Colorado. They have several programs. I'll cover the conventional program that they have. They have a no MI. You have to have a 680 FICO. You can put 3% down on a conventional loan. Of course, your rate's going to be higher, but you won't have the mortgage insurance premium to go along with that. That's an easy way for some people to get in if they don't have a whole lot of money set aside for the mortgage insurance. And a 5% down MI would be probably a barrier to getting into a home. So the extra rate you pay for the CHAFA portion of that is well worth the money.
Is CHAFA grant? I've heard it called grant money, but it's
CHAFA has a couple different programs. They have the CHAFA grant, and then they have the CHAFA DPA second. So one of them is outright a grant. The rate's a little bit lower than that, than the one that's a second. Or is it the other way around? I think it's the other way around. So one, they're just giving you the money, and you don't have to pay it back, and the other is a second, and you do have to pay that back when the loan closes.
Gotcha. Is there a hold period on that loan?
I think it's 3 years on the contract, I believe, is where it's at. But CHAFA is definitely something that you can use if you don't have 20% down. Or at least 10% would probably be okay too, as far as trying to get into a conventional product. A lot of people, we were discussing this before we started, but getting seller concessions is not as easy as it used to be, right?
No, it's not.
Especially not for the lower priced
Right.
homes.
Oh yeah, if you're looking at 260, 275 or
They're
below,
They're
just
going to have They're going to
multiple
have
offers.
multiple offers, so if they can choose one where they don't have to pay seller concessions.
Right, they're going to pick that one. So Chaffa also does programs for VA. I know that we always tout that VA loans are 0 down, but that's not really true. You figure you have 1% for the earnest money. You've got inspection of $350-ish, right? Is that a good average as far as home inspection? 300. Okay.
Oh, well, 300 for the home inspection.
Right.
Add a sewer scope on top of that for 125. Radon, another $100.
So these are all funds that you have to have, and $750 for the appraisal. You pay that prior to closing. It's only out of cost expense that a borrower has out of their pocket before closing actually occurs.
On the loan side, but
On the loan side.
on the inspection side, you do have
Correct. You have
from
the
300
additional.
to 500 or so.
I've seen an inspection that was $850 because they just kept. We want mold tests. We want
Okay,
radon
so
tests. We
all
want
the
sewer
add-ons.
scopes. So all the add-ons, and it came to $850. I was like, whoa.
Well, but you're buying
Yeah.
something for
No,
a long time.
Yeah, I absolutely. If a homeowner or a home buyer is like, I want to make sure this home is a good
Right.
solid house
It's
and
a
it's
good
worth the money
investment,
to
and
me.
they're not going to be putting a whole lot of
I
money
would
into it.
never tell them not to.
Right.
Agreed. Yeah.
Right.
We are in a market where they might not get much out of that, though.
Sure.
You know, but it's good to know what you got and what you can plan
Exactly.
for, right?
So some good things to know about VA home loans is you have to pay what's called a funding fee, which is more or less the same as mortgage insurance. It's just charged up front by the VA, and it's stacked on top of your loan, meaning that it gets added to the base loan amount. For a first-time home buyer, it's 2.15%. If you use it a second subsequent time, it's 3.3%. And the more you put down, the less the funding fee is. So for 5%, it's 1.5%. And if you put 10% down, it's 1.25%.
Isn't the funding fee usually rolled into the loan?
Yeah, it's stacked on top.
Right.
Correct. It's added on top of your base loan amount. You can elect to pay that, actually. Something to note. You can actually elect to pay that outside and make it part of your closing cost. It's happened to me a few times, but it's
Would
not
that
very
lower
often.
your rate at all?
No, it doesn't lower your rate, but it will lower your payment
Cool.
because you're not stacking as much. Because if you figure a $300,000 loan, you're putting 9, 10, 11,000
Yeah.
on top of the loan, so
Yep.
that's going to increase your payment. So-
It's approximately $3 to $5 for every 1,000, right?
Yeah.
So
Somewhere in that neighborhood. What was another point I wanted to make on that? Oh, and you can also be exempt for the funding fee. And if you have a 10% disability or more as a veteran, then the fee is actually removed altogether.
Awesome.
Yeah, so that's a benefit to our soldiers out there. So thank you for your service. FHA, I'll cover that real quick, is 3.5% down is the minimum. If you put down 5%, then your mortgage insurance premium goes from 0.85 to 0.80. Not significant, but it's something. You know, you have a little bit more skin in the game, so they're going to charge you a little bit less.
is the mortgage insurance, is that now for the life of the loan?
Yes, FHA now requires that you pay mortgage insurance life of loan.
So
Now it diminishes based, every year is calculated based on your new principal balance at the beginning of your annual anniversary of your loan.
okay.
So every year they recalculate. So your mortgage insurance does drop as the years go on, but it's significant in the very beginning because most of your payment is going towards interest in the first 10 to 15 years. So you're not going to see a huge significant drop until probably, I would say, years 7 to 10, somewhere in there.
It's a long time to be paying insurance for another party.
Correct.
on
It
the
doesn't
loan.
been mortgage insurance. It sounds so nice. Like, hey, what does that do for me? It doesn't do anything for you. It actually covers the lender to make sure that if you were to default on your loan, then the FHA mortgage insurance would kick in and pay the lender back only 25% of the loan amount. It's not the full. They only pay the lender back 25%.
That's basically so if like you buy a house for $200,000 and then you default on the loan and the market tanks and it's only worth like $180 now,
Right.
the mortgage insurance pays the lender the difference. Is
It
is that correct?
They pay them 20, regardless of the if the market tanks or if the market continues
Sure.
to go up. They're just going to pay 25% of the base loan amount.
Oh, no matter what?
No matter what.
I just assumed it was.
No,
Oh.
no.
See, learn something new every day, guys.
Yeah. With we'll go down a really brief rabbit hole here, but with fractional reserve lending, they're already making their money back with just that 25%. But I'm gonna hold off on the conspiracy theories for this one.
Thank you very
No
much
problem,
for
no
that,
problem,
Rob.
no
Appreciate
problem,
that.
Okay, no, I'm not. I had a short sale. And when I
Almost
was
made it.
when I was negotiating the loss, when the lender kept telling me, we're taking a loss, and one of the things I went back to them with was, no, you're actually not. I know with fractional reserve lending, and I did the math. I'm like, I made 3 years worth of payments. You already have grossed this much payments, and you only put in this, let's call it $3,600 or $3,005 and $50 in the game, and I've already paid you back 10 times that amount. And that actually moved them. They were like, well, okay, and
Nice.
wow, okay.
So you presented math.
Yes,
And they listened.
and they listened.
The listening part is rare.
So it's just important to know the math and know the facts. But anyway, okay, I'll
Right.
stop there.
Okay. Another loan product that we have is USDA, and that's for rural areas. And that's income-based, and it's also where it is in the state.
Are those harder loans to get?
They're only harder because they can only be in specific locations.
There
and
is
you
a
can't
USDA
exceed
map,
certain income limits in order to get in.
So in the general Colorado Springs metro and
Out east.
outside, out east, so
Yeah,
Peyton, Ellicott.
Yeah, I just figured go out east if you want to go to USDA.
Okay.
There's I'm not going to give the URL because it's like 900 characters long, but if you Google USDA rural map, rural loan map.
I can't say rural
Yeah,
either.
rural.
It's okay.
The first link that pops up says USDA eligibility, and it's a .usda.gov link, and that has the map where you can plug an
Right.
address in. It tells you if it's eligible for
Correct.
USDA loan.
Great.
Yeah.
Correct. That's when someone comes at me with that, it's the first thing I do.
Okay. Yeah.
Same thing. Another product that we've recently brought on board is what we're calling like a hard money loan, which is for the self-employed borrowers. We don't look at what you actually show on your tax returns. We look at what you're getting as far as deposits, and then we give you half of that. The rates are significant. Of the two that we've actually closed, I think one was at 8, and the other one was at 8.5.
Wow.
Yeah, well, but if you're a self-employed borrower and you're writing off all of your income so that you don't have to pay the taxes, there's a price to pay for that. And the lender is taking a risk that what he sees or she sees is accurate.
And did you say those were stated income loans? Or?
Stated income, but it's verified.
Okay.
So we will take 12 months worth of bank
Okay.
statements, and we will see that you are actually bringing in an X amount of receipts, whatever you tell us, and then we half that.
Interesting.
So if you
Can
say
is that owner occupied, or can that be an investment property?
owner occupied.
Okay.
on that one. Nice try.
Thanks. So I have one question for you, Mike. Kind of off on a tangent on this, but when you say somebody acquires a property, has a title interest in the property, and there's
Okay.
equity in the property, how much can they refinance that property without bringing any money to the table? How much equity do they need?
Is this an investment property?
It
or-
is. It is. Yep.
Well, it has to have a minimum of 25% in
25%.
equity, and then anything below that we can lend.
Okay.
So you're probably going to want to be, I would imagine, the 50% range if you want to refinance.
Okay.
That's
Or
very
build a-
specific, Rob.
Yeah. Or just hypothetical. Yeah. Hypothetical scenario.
Hypothetical scenario.
Hypothetical. What if I
scenario.
had a property that's a 190 owed and it's worth approximately 230? How much money would I need to bring to you? I'll hit you up later.
Okay,
Okay.
good idea. Another product that we don't personally carry that folks can get is a reverse mortgage. So if you're 62 years or older, you're able to either pull all of the cash out, or you can take one lump sum and then payments over a period of time. But it's a way for older folks who are retired and are looking to cash in on the asset that they have, which is their home, and get a monthly stipend for it.
Just plan accordingly.
Correct.
Making
It's not
sure-
for everybody. It's
Right.
very specific and very unique. And like I said, we don't offer them. I've known some friends that have utilized them, and it's worked for them. But it's very specific.
It's kind of like a rent to own, in that there's a specific market niche in which they do work.
Correct.
You know.
Correct. Couple things I'd like to also mention that we offer 10, 15, 20, 25, and 30-year notes. So depending on where you are as far as your budget, your debt-to-income ratio, and how long you want to hold the note. So we have different options available to you. And we also offer ARMs, which I highly dissuade, especially in the current environment where rates have been going up since pretty much late December, early January.
I know a guy. My next
know
door
a
neighbor,
guy,
yeah,
huh?
he had a negative amortizing arm.
Oh.
Yeah, that was joy.
Oh,
He had
yeah.
every month the balance of his mortgage went up.
Yeah.
Because he was, it was.
Yeah,
he was
that
paying-
was really popular prior to 2008.
I think he was paying. I want to say it was like $1,400 on a $2,300 a month mortgage, and so every month his principal balance went up by $900, and he was just banking on market rising. When I found out about that before I was an agent, I was like, that just doesn't make a whole lot of sense. And then the market collapsed, and
Yeah, and that's what people were doing. I mean, that was the Wild West days of lending and real estate. To be honest, I think it was both parties, both of us.
The agent I had at the time was telling me that in that market in Vegas in particular, his phone was ringing nonstop from the time he turned it on to the time he turned it off at night, and people just desperate to grab any house. They were making offer on the next thing you see because they were trying to grab stuff, and then also
they were speculating.
If they could get it, they knew. But in some cases, he said by the next day you could flip it near the end. You could flip it for $10,000, $20,000, just your place in line, I'd like to think if I knew all that.
Where's all the rationality and when that happens, people just don't think. No. Bitcoin is another example of that. It went up to what was it, like 16,000, 17,000, and then.
So I met somebody recently that was telling me, and they're heavily into that, and they were saying that there's a lot of big money on the sidelines. I have no way to validate this, etc. But that big money is artificially suppressing the value of Bitcoin. They said so that they can buy in at a lower price point. No, I don't know. I don't know. Yeah.
Well, what is it? The Winkle brothers or whatever? They own a tremendous amount of Bitcoin. They
follow the money.
Lot.
Always, that's my opinion. Always follow the money, and
right.
if the market starts to come unhinged, like we were just describing, that is not a time to put your always look long term. We always talk about the long horizon and
right.
Don't bank on continuing.
Don't play the short game.
Yeah, because you may be the one caught if you're playing musical chairs like that. One caught standing. And,
right.
And
when the music stops, and that's what happened to a lot of those folks when they had those interest-only loans.
The music stops. Literally overnight. Yeah. Okay. Any other things you'd like to mention?
I don't have anything else. No.
I have one more question.
Sure.
All right, let's go back to income properties. So there's all these down payment assisted programs for when you live in the property. Does anything like that exist for income properties?
No, you may not.
Okay.
In fact, you can't even buy a duplex. I researched that for myself.
Mm-hmm.
Chatham will not allow you to buy income property and utilize the down payment assistance.
Even if you live in the other...
Even if you live in it.
Interesting.
Yeah.
Well, VA loan, you can buy a quad.
VA, absolutely.
Okay.
Yeah.
Gotcha.
But you have to live in one.
Yes,
correct?
it has to be owner-occupied.
Okay.
Absolutely.
Right on. Okay. Well, anybody read any books or listen to any podcasts?
I'm still listening to the one thing. I'm really hooked on that at this point. It's actually really powerful.
I'm still working on adaptive markets and the efficient market hypothesis.
You should adapt and maybe read something else at this point.
To be true, I'm also reading Automate the Boring Stuff with Python programming language.
Oh.
That sounds so fun.
Terribly exciting, yes.
Do you alternate between the two?
I do.
Okay, good.
When the adaptive markets gets too heavy, I move over to
okay.
this. And then
that makes sense.
So working on my programming skills. But both are good books. And again, the efficient market hypothesis it sounds so simple, but it's actually quite interesting on how the market perfectly prices all information at any given point in time, and then how all our efforts to predict future behavior of the markets are
futile
because you just so anyway, fascinating book. Anything?
Oh no, I've been unplugged. I've been playing a lot of Dungeons and Dragons with my kids. So.
Nice. That's awesome. You have quite the setup I saw on Facebook. I saw that picture.
I'm quite the dungeon master.
Mike, what are interest rates going to do?
Oh, well.
Do we have our 8-ball?
No, actually, I think we forgot to bring it into the room this time
my
around.
Goodness. Okay. Well,
I'm just going to step on a ledge and say, hold steady.
Hold steady? Okay.
Hold steady.
Hold steady? Okay. Right on. Oh, so anybody looking to buy or sell, how do they get a hold of you guys?
They can reach me if they want to get a mortgage at 719-505-3467. That's my cell phone.
Right on.
And once you get pre-approved with him, you can give me a call, 719-964-0632, or find me at my website or on Facebook, Laurie Ristig.
You should check out her Facebook profile and her sweet Dungeons and Dragons master. What do you call it?
My
Dungeon
main
master.
page, my personal page.
Yeah, you got a nice setup.
Good stuff.
Right on. Okay, this has been TBD, your Colorado Springs real estate podcast, and we'll catch you next time.
Bye.
Bye.